I retired in 2017, but if I followed the 4% rule, I'd still be working. Today, I'll break down why I ditched the 4% rule, how I used the 8% rule to retire earlier, and whether it might work for you too. The 4% rule is so popular, I'd go so far to say as it's mainstream.
The 4% rule.
4% rule.
4% rule.
The 4% rule.
It's all over financial websites like Fidelity. The simplified version is that you live off your stock portfolio by selling 4% per year. The stock market returns are more than double the 4%, but this conservative number gives you a cushion against the down years. The math works, and I'm not challenging the theory, but I have two issues with it. Number one, you need a lot of money. $1 million to create 40K of pre-tax income. And number two, it's potentially stressful if you retire in the wrong year. Imagine if you spend your whole life saving $1 million, retire on December the 27th, 2021, and 9 months later, your portfolio is down 23%. We know it bounced back, but here in September, you don't know what's going to happen. You just know $230,000 has disappeared from your account, and you're supposed to sell another $40,000 at depressed prices to pay the bills for the coming year. That would stress me out. That time it bounced back quickly. Another time, you might have to wait a year or two. Statistically, it should all work out in the long run. I just don't want the stress. This timing issue is a big deal, and it's known as sequence of returns risk. This chart, ironically from Fidelity's UK website, shows the difference between retiring before and after the dot-com crash. 3 years made all the difference. So what's the 8% rule? Well, fundamentally, it's switching from growth to high yield. But to be more specific, create a portfolio of high-yield investments that produce enough income to pay you an income of 8% per year and grow the portfolio income each year to stay ahead of inflation. I should insert a disclaimer here. This isn't an official rule produced from a Harvard study. This is just what I've been doing for the past 6 years and my lessons learned. It's hard to find individual stocks and funds that pay 8% and grow their income each year, but it's not difficult to build a portfolio that does that. I'll consider a yield of less than 8% if there's consistent income growth to reach an 8% yield in the foreseeable future. For example, Main Street Capital pays 7%, but it has a long history of growing that dividend every single year. If you bought it 3 years ago, it would now be yielding 9.49% on what you paid for it. If history is any indication, that income will continue to grow each year. Then there are the stocks and funds that pay more than 8%. UTG pays 9%. That's more than I'm looking for, so I reinvest that extra 1% instead of spending it. That provides some compounding so that the income from UTG continues to grow. UTG also has a history of raising its distributions. Not much, just a little bit, but it helps grow the income. Here's another example. SBYI is currently paying 12% yield. It varies by month, and 12% is actually higher than normal, but it's more than 8%, which is what counts. Of the 12% yield, 8% goes to pay for my life, and the other 4% is reinvested to compound and grow the portfolio income. Now, I should clarify that the philosophy I work under, but I don't actually reinvest the excess over 8% back into each individual fund. As a practical matter, I just project the 8% I'll be using to live off, and the amount over 8% is reinvested monthly into whatever is attractively priced at the time. In other words, I don't do it individually by fund. I don't sit on cash and try to time the market because cash pays me less income than my investments, and more importantly, I can't predict the future. I'm not a trader. Good stocks don't pay 8% unless there's a problem. The Procter & Gamble's of the market don't even pay 3%. To get 8% from a traditional stock usually means there's a major issue. For example, Altria's yield has more than doubled to almost 10% because the market is concerned about falling demand for cigarettes. I'm not saying Altria is a bad stock. I don't follow it, but if you want to invest in it, you better believe in their plan to pivot to vapor or some other turnaround product. So where do we get 8% from? I'll give you 6 categories with examples. There's a huge demand for high yield in the form of a well-packaged ETF, something that offers low fees, diversification beyond one company, and the backing of a brand. The hottest product in this category is the Covered Call ETF. You take the safety of an index like the S&P 500, sell the rights to some of its upside in the form of covered call options, and bingo, 7 to 12% annual yield paid monthly. JEPI has attracted $30 billion in less than 4 years with exactly this strategy. Trailing 12-month yield is 9.3%. These examples are for illustration purposes. The specific stocks and funds you actually use will depend on timing and your risk tolerance and a bunch of other factors, of course. The next two categories are in the lending business, starting with business development companies or BDCs. These are private lenders that can charge higher rates than banks and have the flexibility to take equity positions in the companies they lend to, something that banks can't do. Ares Capital has a 19-year history of consistently raising its dividend and is currently yielding 9.8%. The other lending category is the mortgage REIT. You're probably familiar with real estate investment trusts or REITs. They invest in real estate and pay out 90% of their income to investors. Some of these make good investments, but they typically yield closer to 5%, a bit lower than the 8% rule. Where do REITs get their money from? Well, mortgage REITs. In other words, mortgage REITs or mREITs don't own real estate. They lend money to funds that own the real estate. ABR has raised its dividend for the past 11 years and is currently yielding 13.2%. Preferred stocks are like a hybrid of common stocks and bonds. They pay dividends, but the amount is determined in advance. It typically begins as a fixed percentage of $25. For example, 6% of $25 equals $2 per year. Some of them later switch to a variable rate. They don't offer as much upside as regular stocks, but they're also less volatile. They tend to move in the opposite direction of interest rates. So as interest rates have been rising, preferred stocks have been getting cheaper, which means they're paying a higher yield than when they were issued. Annaly Capital Management, 6.95% preferred Series F, ticker NLY.PRF, that's a mouthful, is currently paying a yield of 10.6%. Closed-end funds mostly, but not always, use leverage to boost their yields. Unlike ETFs, they can trade above or below their asset value. That creates an opportunity to buy them at a discount to their asset value and sell them at a premium to their asset value, if you're into that kind of thing, or you can just hold them. The negative is that their fees are higher, partly because of the interest expense created by the leverage. BlackRock Science and Technology Trust has been growing its dividend since 2014 and is currently paying a yield of 9.1%. Last but not least, master limited partnerships are mostly focused on the energy sector. That's a volatile sector, but there are MLPs that focus on less volatile components like transport via pipelines. HESM has a dividend chart that shows consistent increases and is currently yielding 8.3%. I've made videos about specific investments in each of these categories except for MLPs, but I plan to cover that topic soon. Each of these categories comes with its own risks, so diversification is important to minimize the impact of any one investment. I typically hold about 20 to 30 stocks and funds with a maximum allocation of 5% to any one stock or fund. The right number depends on how many investments you're comfortable keeping track of. For some people, that's 10. For others, it might be 50. 8% isn't set in stone. 8% works for me, but it's not a magic number. Stephen Bavaria is more aggressive than I am. He wrote a book called The Income Factory, which follows a similar income-based philosophy. But he'll buy closed-end funds like OXLC, paying 19%. He's more comfortable with dividend cuts than I am, so that one wouldn't be for me. Maybe your number is 7% or 9%. My point is just not to accept the 4% rule as a law of the universe. This isn't for everybody, so let's look at why it might not work for you. Tax is the obvious one. Growth is usually more tax efficient than income, especially when you're working. There are a lot of factors affecting your tax situation, like the country where you're taxed, whether you own investment, real estate, etc. I've seen investors who optimize their portfolio for things like paying the lowest tax, paying the lowest fund fees. Vanguard attracts a lot of customers for that reason. And thirdly, dying with the biggest portfolio. The NASDAQ 100 would be my bet to achieve that one. Even though we all spend our working lives focused on building the biggest nest egg, as retirement approached, I actually changed what I optimized for. Aside from the obvious part of generating enough income to pay for expenses after inflation, I decided to optimize for, number one, retire early, and number two, to detach myself from the stress of market volatility. I don't want to be happier on green days or green months or even green years and then stressed when the market is red. When the market is hot, I'm thinking about which stocks or funds are so overbought that their yield has fallen to an unacceptably low level and then maybe swap them to something with a higher yield. Great. And when the market is correcting, then reinvested funds are buying at higher yields, creating more income. Either way is fine. I should clarify that most days and most weeks, I don't buy or sell anything. I think the biggest reason not to pursue this style of investing is that you have to take responsibility and you have to do some work. I love reading about income stocks and funds. I could talk about it all day, even till my voice is gone. This channel is partly, I guess, a form of therapy. But if you're not passionate about this stuff, you don't enjoy researching and monitoring your portfolio, this probably isn't a great fit. Fortunately, there's a correlation between inflation and yield. Inflation is currently high and the Fed has provided us with a boost in yield to cope with that. Keeping up with inflation is addressed two ways. Firstly, reinvesting a portion of the income. So if the blended yield is, say, 10%, spend 8 and reinvest 2. Secondly, selecting some stocks and funds that grow their income. Some examples would be Main and ARCC. Not every stock in the portfolio needs to grow their income, but the overall portfolio does need to grow. I wouldn't have made this video at the beginning of my retirement because I didn't really know what I was doing, but 6 years in, I can say this definitely works for me. The only time I felt stressed was in March 2020 when it looked like parts of the economy might break. It wasn't like a recession where we could just use historical data to estimate the worst case scenario. So out of fear of dividend cuts, I tried to time the market. I did some selling and sat on some cash. Turns out none of my stocks or funds had dividend cuts, and sitting on cash for a while actually cost me income. And I had the stress of trying to time when to buy back in. My lessons learned from that were, number one, be extra stringent about selecting for resilient income stream. And number two, trust those choices. The only thing I would have changed is to start earlier with a small portion of my portfolio. Then I would have been a bit more knowledgeable about income investing on day one of retirement. But being realistic, I was so focused on work that I wasn't really in the right frame of mind to focus on this properly. I'm not saying the 8% rule is better than the 4% rule, but it's definitely better for me. When I was working, I didn't really enjoy researching and managing a portfolio, and now I do. It's basically sitting in a coffee shop or in an armchair at home, swiping on a phone screen and collecting income. Armchair income. So now you know why I call this channel Armchair Income and why I don't talk about popular but low dividend stocks like Apple or Microsoft or no dividend stocks like Tesla. If you're curious to learn more about stocks and funds that pay high yields, you could start with the playlist I created called Top 10 High Yield Favorites. And if you'd like to know exactly where to find these high yield investments, here are the 7 places I go to find new investment ideas. That wraps it up for this look at the 8% rule. More Armchair Income coming soon. Oh, my voice. I'm dying here. I'm dying.